You might have seen the new narrative going around. 2026 is going to be a really bad bear market. The midterm years are historically very dangerous. The data proves it. I mean, at least that's what you're hearing right now on X. It's what you're seeing. It sounds convincing at surface level. There's just one problem. It is completely wrong. So there's this narrative going around that I saw on X right now, and it's saying that midterm election years are dangerous for markets, that the S&P 500 always has huge drawdowns going into midterms, and that 2026 is supposed to be some kind of warning year because of midterms. But here's the thing, none of that is being presented accurately. In fact, 7 out of the last 12 midterm years ended positive. I'll show you in a moment. And besides that, when you actually look at the data, especially from a macro and liquidity standpoint, the whole entire narrative falls apart instantly. I'll show you in under 10 minutes exactly why. So today I want to walk you through the real numbers, what actually happened in past midterm years, and why 2018 and 2022 have nothing to do with elections and everything to do with liquidity. So there are charts floating around showing the largest drawdown in the 12 months before midterm elections. And I just want to interject for just a moment. I know I have a bar chart post up. This video that I'm doing right now in no way is calling out bar chart. This is just a post that they posted. It has all of the context to the narrative that's going around right now. And I want to use this data here, and I really just want to dig into it specifically, because I just don't think it tells the full story. And the framing of this thing makes it look like every midterm year is some kind of crash. Markets bleed before midterms. Elections equal volatility, and that equals danger. But here's the trick about it all. That chart and that data point is only showing the worst intra-year drop, not the actual performance of the year itself. Every year has a drawdown. Every year has volatility. That doesn't make the year bearish. This is one of those situations where the data is technically correct, but the conclusion people jump to is completely wrong. And I think that is dangerous. So here's the thing that not many people are telling you. 2017 had less than a 3% drawdown and finished up over 21%. 2019 had about a 7% drawdown and finished up over 31%. If you only showed the drawdown, you'd think those were uneventful years. They weren't. They were some of the best years of the decade. Now, I know those weren't election years, but the point remains, you can't look at drawdowns within a year to come to a conclusion on how a year did. So let's look at what really matters. The full year S&P 500 returns during midterm election years. Going back to 1978, 7 out of the last 12 midterm years ended positive. These are strong years. There's nothing bearish about that. And yeah, many of them have drawdowns within the year, but pretty much every year has drawdowns. It has nothing to do with elections. The S&P 500 has historically outperformed in the 12 months after a midterm election with an average return of 16.3%. The last time the S&P 500 produced negative returns in the 12 months after a midterm election was 1939. Now let's talk about 2 specific midterm years that recently did close red. And here they are, 2018, 2022. So we do know 5 out of the last 12 midterm election years closed red. 2 of those years were 2018 and 2022. Even for those most previous 2 midterm elections, why did 2018 and 2022 actually close red? Why did they crash? The answer changes everything about how you should be thinking about 2026 and the midterm elections. And real fast, a quick shout out to our awesome sponsor, iTrust Capital. If you're serious about crypto for the long game, iTrust Capital lets you buy and trade over 80 cryptocurrencies 24/7 inside a tax-advantaged IRA. They also have a secure custody account if you don't want the IRA route. They use institutional-grade storage through Coinbase Custody and Fireblocks. There are no monthly fees, and setup takes just minutes. And right now, they're giving you, my CCV viewers, a special $100 funding bonus. Just use the link below and fund a new iTrust Capital IRA or custody account, and they drop $100 into your account once it's funded. Because 2 of these years, the most recent ones, 2022 and 2018, were the only 2 quantitative tightening seasons in US history. 2018 quantitative tightening cycle, the Fed was pulling liquidity out of the system aggressively. Risk assets struggled across the board. The Federal Reserve and the world's other major central banks have also been tightening their monetary policy. That reduces liquidity in the market. That's from 2018. Liquidity. Now the 2022 quantitative tightening cycle, even harsher. Quantitative tightening, even more liquidity removed. Every risk asset class, stocks and crypto were affected. And even right now in crypto, we're still affected by this liquidity squeeze. Check it out. The Federal Reserve raised interest rates 11 times, starting in March 2022. It also reintroduced a policy of quantitative tightening in June 2022. The Fed's quantitative tightening program, which began in 2022, removed approximately $2 trillion from financial markets over 3 years. This liquidity drain contributed to crypto's bear market in 2022 to 2023. These weren't midterm crashes. These were liquidity-driven corrections. And if we're being real, elections were pretty irrelevant. Quantitative tightening was everything. The danger isn't the election cycle. It never has been. The danger and the opportunity always comes from liquidity. Are we in quantitative tightening? Are reserves falling? Is the Fed draining or adding liquidity? Is fiscal expansion coming? Are financial conditions tightening or easing? That's what matters. Those are the questions we should be asking. Midterms don't move markets, liquidity does. And when you zoom out, the data proves it. So I wanted to do this very quick video because the next time you see this online, you see these posts, you see these midterm charts, midterms are dangerous for crypto or for the stock market. Ask one question. What was the Fed doing that year? And if you don't get an answer, it's probably better not to listen. Check this out. Half of the 10 largest quarterly stock market rallies and sell-offs between 2010 and 2018 began within a week of a Fed statement indicating that the central bank would either pursue or cut back on conventional policies. Crypto doesn't care about midterm cycles. It cares about liquidity rotation, money flowing out the risk curve, going from quantitative tightening to risk off, quantitative easing or stabilization to risk on. Sentiment shifts once uncertainty clears. During the COVID era QE 2020 to 2021, Bitcoin surged from $7,000 to over $60,000. In mid-2022, as the US Federal Reserve raised rates and began QT, Bitcoin dropped from $40,000 to under $20,000 within months. If anything, midterm years often end up being setup years for big crypto moves after the volatility clears. That's why the historical averages show strong 12-month performance after midterms, not because of politics, but because uncertainty passes and liquidity stabilizes. So yeah, at the end of the day, midterms aren't some special bearish signal. So don't let these midterm election narratives without the full data or these headlines distract you. If you want to understand where markets are headed, especially crypto, just look at liquidity, not the election calendar. And by the way, 2026 has its own liquidity setup forming. Quantitative tightening officially ending December 1st, 2025. That was a big deal. And when it comes to liquidity, I've been breaking all these things down on this YouTube channel. So if you're not a subscriber, please subscribe and turn notifications on. And if you enjoyed this content, please consider giving it a like. Thank you so much for watching. I'll see you in the next video. God bless.